When you look at around the world, what are markets most underestimating in terms of the risks out there?
You know, on balance, we're actually very constructive about the markets. And, you know, we're calling for a soft landing in the U.S. We think the ECB has done a really good job. We're obviously a little bit concerned with China and some of the structural issues that are necessary. And we're also working our way through all the tariff negotiations. And I suppose maybe that's the piece of it, which is realizing that we've been in a period of time where we've had ultra low interest rates, a lot of fiscal stimulus, this ongoing globalization. This chapter is coming to a close. Clearly, America is focused on America first. And so that notion of just buy the S&P 500, if you own that for the last couple of years, you would have been just fine. It's all about making sure that portfolios are very diversified because it is difficult to price in the uncertainty and volatility. And so I don't have necessarily a risk that we don't think the market is thinking about, but from the perspective of investing, holding gold, holding cash, holding private markets, being deliberate about all of that is in a very important way forward.
Jen, is there something you worry about, valuation?
No, I agree with Yie-Hsin on the point she's made. I would just add, I think the market may be a little bit optimistic on the number of rate cuts. I think that inflation is probably going to be, you know, more difficult than to come in and maybe even, we might even see, I mean, obviously the tariffs are going to come through. You look at U.S. employment and, you know, on the one hand, the 900,000 jobs that, you know, suddenly didn't exist, people say, well, is that a weak labor market? And yet you had wages go up 4%, in some cases 5%. And so, and immigration had gone from like 3 million people coming in to now 1 million and even less. So that's absorbed. At some point, there's going to be continued wage inflation if you have less immigration in, right? And some of it's been offset probably by productivity gains in companies and some of those things. But I just think that inflation is a potentially bigger problem. And so you're not going to get the rate cuts that the market thinks it's going to get.
Because it's stickier.
It's stickier. And by the way, remember the big, beautiful bill, those, I do call it tax extensions because there were more tax extensions in it. But some of that was front loaded. So that's going to be a stimulus for next year. All those things are kind of inflationary.
Yeah. Do you worry about inflation or the labor market in the U.S.?
Well, I'm going to disagree with you, Jen.
Okay. All right. Good. That makes a better panel.
So from our perspective, we do think the inflation hawks have it wrong. We've been worried about the labor side. And obviously, the Fed has a dual mandate. And from our perspective, yes, we've seen some goods inflation. But the services side is showing deflationary pressures. And when you think about housing and rentals, we see that really coming down. And so inflation, in our view, 3% last year. We think it's 2.8% this year, 2.6% next year. And wage growth is slowing. Unemployment is ticking up. It hasn't impacted the consumer yet, and that's one of the reasons why we're optimistic about the U.S. equity market. But we think it's critically important that the Fed continue on its path of easing. We're calling for another 50 basis points this year, 50 basis points first half of next year to really get to a neutral rate closer to 3%, which we think is more sustainable relative to the growth of the economy.
I mean, I know the Fed drives everything, but are you sometimes amazed at, given everything that's going on, geopolitics, China, you know, there's multiple wars on multiple fronts, debt concern, the U.S. government shutdown that we're experiencing, that, you know, the markets are a little bit too focused just on interest rates?
Well, the consumer's still doing great in the U.S. I mean, they're still spending, and actually, if you look at the market, I mean, earnings are pretty good. You still have pretty good earnings growth. I think there are segments that some of the policies are really hurting. I think like agriculture, hospitality, some of those things. But in general, the market's still and the economy's still really strong. So I'm putting on the side of saying that. We're going to have good markets here, and but again, that's why I think we'll have a little bit more inflation than the Fed. So I would put it at the 25 basis points one time this year.
Do you look through the U.S. government shutdown?
You know, if you look back in history, 20-plus shutdowns, they tend to last 1 to 2 weeks. I'm not going to say I'm projecting that is going to be the case here, But there are clear policy compromises that can be made here. There's an exit ramp that's available. And typically when you see a shutdown, it's modest impact to economic growth, but once there's a resolution, you gain that back. And so many regards, I would say the market tends to look through these episodes.
In 2018, the shutdown, the market, initially for other reasons, the market dropped and then it actually went up and bounced back. So we seem to get through them.
I mean, there's not a single day that goes on without us talking about private credit, private markets. Is there anything that we're underestimating, actually, with the very rapid growth of private credit?
Look, again, I always say with private credit, you got to remember that banks used to be the lenders. Capital requirements were such that it changed it. So now that's shifted into the private markets. I think the key is, but this is consistent with any credit. With credit, you always have to find where the opportunity is, right? So right now, you look at the high yield market and even the private credit market, some portions of it are priced for perfection, right? Like you want to know people are optimistic about the economy? Look at the fixed income markets. So you have to find where there's opportunity. And the key, I think, is to remember that private credit is illiquid, and therefore you have to get a premium. You should get a premium for that, so kind of demand that. Am I worried about private credit? Not yet. What I've said, one thing that is a concerning trend is as you get into these perpetual products from drawdown, it's always a bit riskier when you have to deploy capital in the case of credit, because sometimes you're better off saying, well, you're not getting the risk-adjusted returns that you should for it. So I think that's just a trend that we should keep our eye open on.
But Jenny, Franklin Templeton has really expanded, quite a lot into private credit.
Yep.
The integration, I imagine, hasn't been without tension, because if you're a traditional asset manager, it's quite different to private credit investing. So how do you navigate the two in terms of leadership?
I actually, honestly, don't think it has been. I actually think there's tremendous respect from both parties, and actually they view it as where there's an advantage. Matter of fact, if you're just a traditional fixed income manager and you don't have access to talking to people in private credit, it's like you're managing with half the information. So we ensure that our teams are talking to each other to understand how it's evolving. And as a matter of fact, I think we're all doing is trying to figure out appropriate products where you can incorporate private assets into, combining with your traditional fixed income.
Yeah. You're also going into just much more alternatives. Is there a strategic challenge in trying to build scale in some of these projects?
Look, I think that I first want to agree with Jenny in this case. I see, tremendous value creation happening in the private marketplace. The liquidity and capital are available to private companies. The bank regulatory environment not likely to change dramatically, that we're going to see increased private credit. So, the view that these are exposures that large institutions, ultra high net worth individuals have had access to for a very long time, yet individual investors have not, has really been a big focus for us at State Street, and partnering with other firms that have these capabilities, in this case, Blackstone and Apollo, and bringing some of these exposures. In the Apollo case, we're really focused on the U.S. investment grade core plus segment. Many managers will have emerging markets debt or high yield within the plus component. We're talking about private investment grade with that premium that's available. And so I think very innovative, creative structures are coming to market that are really with that intent of helping, whether it's retirees and target date funds get exposure to private markets, or in our case, ETFs. We think it makes a lot of sense.
Do you see the need for a cultural shift? Because some of the, this space maybe is more relationship driven, it's faster paced.
In many respects, I think that all of our worlds are sort of merging together, right? Institutional versus wealth. I think there are very sophisticated firms that are advising clients, that are incorporating private markets inside of portfolios. Likewise, if you invest in a target date fund that has, say, 10% allocation, that's already built for you, right? That's a glide path. And so I think that in general, maybe some of the behaviors that we have seen from individual investors in decades past, I think is a very different situation today.
How will it change the financial industry in 3, 4, 5 years? How much do you think longer term, actually, about you and your competitors? Jenny?
Well, look, there's a reason why there's this massive proliferation in alternatives and private assets, right? So in the case of private credit, we already talked about it. A lot of the bank lending rules and capital requirements, I think, has pushed post the financial crisis into the private credit. And I think in private equity, I mean, companies are waiting longer to go public. You just saw yesterday, I think it was yesterday, Electronic Arts just went private at a $50 billion valuation. Right? You can't imagine in the past that there was enough private capital for that. Well, why? Because one, a lot of the rules around public companies and quarterly earnings and things force CEOs in a time of great technological innovation there's a fear that to meet those quarterly earnings, they're not making the investments that they need to make to ensure that the company's positioned for the future. There's pressure on compensation. There's a lot of pressures on and the cost of the regulatory compliance to be public. So companies are choosing to not go public and going private from being public. So I don't think that trend changes. And if anything, in this time with the technological advances, as I said, I actually think there's even a greater reason to stay private.
Feel free also to send questions. There is a QR code. Go for it. It's anonymous. No, I'm kidding. It is anonymous. Do you see a big change in
I think a lot of the trends that we've been seeing, sort of barbelling of portfolios, index for large market exposures and alternatives growing, I see that continuing. I do think a lot of investors and wealth platforms are increasingly wanting to do business with fewer providers. And so this trend of the larger firms, whether it's on the public market side, private market side, getting bigger and bigger, I think is a theme that continues. The desire by investors for a really strong value proposition, which in turn has put pressure on our top line. But that at the same time has come where there's so much technology that's available for all of our firms to really think about how do we streamline our entire process, deliver a really strong client experience. And I think the other exciting thing that we're seeing is just the ability to leverage technology at scale and customize, personalize at scale. And so, we've partnered, for example, with a firm in the US called Ethic that provides this automated tax-optimized solution for clients. And I think it is beginning to make certain markets, when you think about India, for example, payment systems are much more robust. Ability to transact is a lot less costly. And so we're seeing new investors coming into the market. And I think that's an exciting space.
I mean, I know there's a couple of ideas being floated around, get rid of quarterly earnings. We're not sure whether that sticks or would be regulated. But does it also change public markets, or will public markets want to change?
I don't think if you go to changing to reporting every 6 months, I don't think that's enough to change and people say, oh, now I want to stay public. I don't think that's going to be dramatic enough. I think there's a lot of fundamental issues around being a public company, and we need it. Like, we need the liquidity. We need a lot of public companies because most people, it's the best way for them to get investments. They need to have that liquidity. Yeah. And so we have to, I think, be honest with ourselves about why it is that people are choosing to stay private.
You mentioned technology. Do you feel like you're at the moment the financial industry could be disrupted? So how much time, in your working day, do you spend thinking about disruption, AI technology, or acquisitions?
A tremendous amount, because I think the world is changing quickly, and I say that every year, and I feel like the following year it is even changing faster. And so I think all of us in our industry have to look beyond, what we're doing in our financial services realm, but look broadly. And so the technology, how it can be used to create greater efficiencies and productivity, I think we're all doing that. Looking at opportunities to get greater insights, whether that's in the investment process or delivering for our clients. I think in many respects, we're still early innings. These are questions that we get from our clients all the time, like winners and losers with blockchain, with AI, with quantum computing. And frankly, I don't know if we have all the answers. But what I think is exciting from an investment perspective is the ability to take advantage of these greater macro themes and to ensure that there's that allocation, because we know these spaces are really, they have the potential to disrupt. Exactly what the outcome is, I think, is still to be played out.
Will we see more deals like you did with Apollo? Is that like a blueprint of things to come?
We're very much oriented around partnership. I would say if there's one theme that runs through State Street, it is that. We know what we're really good at, and ETFs is a big part of our business, and so partnering with other, what we consider best-in-class firms to bring their capabilities to market, Apollo, Blackstone, Bridgewater, all of those are partners. So I think the answer is yes.
Jenny, how do you see, again, how do you see your firm actually changing over the next 4 to 5 years, and what do you spend most of your time thinking about?
Well, I mean, so, you know, we got big in private assets, so we're about $260 billion at Franklin Templeton private assets. We just announced a partnership. We had wanted to do more in the infrastructure space. We think that's really important. Infrastructure is a great asset for particularly people who are retirees, want some source of income, but also get some upside. And we ended up partnering with 3 firms to pull together, and then we're going to, you know, package it and basically leverage our distribution capabilities. You know, one thing that I think is really important to understand the differences as you talk about these various firms, as you move from these alternative managers who have historically just sold into institutional clients, where the client knows exactly in a pension fund what their cash flows are, to being able to talk to financial advisors of individual clients, the education that's required is really significant, and the investment in education is really important. And we spent a lot of time on that component of it to make sure that suitability is appropriate. And I think that all of these things, as we're coming together, it is really important. The financial advisor is critical because they're the tip of the spear in figuring out whether it's appropriate and suitable for an individual client.
In terms of, you know, the leadership, Jenny, you just added a new co-president, Daniel Gamba, to the firm. What does that mean for succession planning? Are you planning to step down?
It's so funny. Somebody asked me that question. I was like, what are you talking about? I'm just getting started. No, I couldn't be happier about Daniel coming. He was actually a CEO or president over a $1.3 trillion asset manager, and I had to convince him why. And, you know, Yie-Hsin talked about it. I think that the bigger getting bigger in asset management, and the reason why is you have to have full breadth of capabilities, and I genuinely believe that if you don't have scale, your ability to train your AI models, you're going to be left behind. And data is very expensive. We know because we buy it from places like Bloomberg. But so, yeah. So honestly, to be able to attract Daniel and also to recognize 2 other folks who are on my team and the good work that they do, we created a model. We actually have 3 co-presidents under me. So I gave up the president title, and I'm still the CEO. So I always thought it was kind of silly to be both president and CEO anyway.
What are you like as a leader? I mean, in these, you know, when you look at what you've bought and it's big and you're trying to get bigger, is it really culture fits that you have to work on, and how
100%.
Difficult is it to pass it down
That is
from
the
top?
biggest thing that happens in this, right? It's easy to buy a company. What's hard is making sure you're integrating and that it ends up being more than just the firm being added to your firm. And so we spent a lot of time getting our CIOs to know each other and talk to each other. And I'll tell you, to me, it was like a breakthrough when this was what our growth equity CIO was having a heated debate with our deep value CIO on whether NVIDIA was overpriced or underpriced. And both just fundamentally believed it. And it takes time for that to build that kind of trust to be able to do that. And then, you know, we came out with a real estate debt fund, and actually it came out between our real estate private credit team, or actually our private credit team post-COVID was saying, gosh, if we have to foreclose on a property on this real estate debt that we have, we're just going to have to sell it in the market. We've never managed properties. Let's talk to the real estate clearing partners. So they started doing these calls every 2 weeks to just talk about kind of what the market looked like. And it was the clearing partners who said, hey, all the regional banks were the lenders. They've retreated post-Silicon Valley. We should step into the space. And so we launched a real estate debt fund. And our multi-asset team actually was the one that seeded it with $500 million to give it scale right out of the gate. So to me, having 3 CIOs, all of this came out of our CIOs. It didn't come out of product development. And to me, that's a sign of, you know, success by being able to get them to spend enough time together that they value each other's insights and have those conversations. And so I view it as that's kind of my job, is making sure the team is actually playing like a team.
Yeah, and this is also something that, I mean, leadership fundamentally boils down to making sure that, the culture fits, the culture works as you want it to be.
That's right. And to me, I think in this position, it's really three key things that are critical. One is strategy, which you talked about, asked us about, the right direction for the firm, recognizing your strengths, your ability to deliver value and punch above your weight. Two is having the right people in the organization. Jenny spoke about that with her co-presidents. And lastly, culture. And I think culture matters a lot. We're an organization that's very collaborative. We work very closely with our clients and partners. Our mission is really to be the world's leading partner and provider of innovative investment exposures and tailored solutions for our clients. We need to be really listening carefully to our clients, connecting the dots, moving with agility, moving with speed, but also with a focus on the heritage of the firm, which is very much about democratizing investing. When we essentially gave birth to the U.S. listed ETF industry some 32 years ago. So that is a theme that cuts through. And so culture is one of these things where it's just about the values you hold dear and reinforcing that at every part of the organization.
Do you hire differently now than you did 5 years ago because of AI or because of the value sets or the tools at your disposal?
There's some things that you just never change. I always, when people ask about culture and acquisitions, I always say, in acquisitions, the investment banker will tell you why it's a good price and a good strategic fit, but they'll never talk about culture. And so we always say we look for 3 C's. Firms that focus on the client, and you can tell in due diligence how quickly are they talking about the client. Are they collaborative? Does the management team like each other? I mean, we actually invested in a company where after 6 months I met the management team, and I was like, you guys understand they don't like each other, right? And guess what? It didn't work out, right? Collaboration is really important. And then finally, this mindset of continuous improvement, right? Are they people who are curious, who want to continue to do better? You always have to hire for those things, right? And then it becomes the skill sets around what are you looking for. And I think, it's going to be interesting. We were talking about it earlier, just even with our kids, as they're leveraging tools. I mean, I'm so old that when I did math, they didn't let you have your calculator in the class, right? Because you had to learn how to use math, right? And so they're trying to figure out, how do we deal with all these AI tools in school? And I don't know that any of us really understand what that is. But you want people who are willing to try these new things.
But Jenny, when you say you can tell very quickly after a conversation whether they put client at the forefront, what do you mean?
You can, you and I just had a conversation about an event that we had where somebody made a comment that we were shocked that I said, that must have been an internal voice. I don't know how it came out externally about how they were thinking about clients. You can tell. You can tell whether people genuinely are there. I mean, at Franklin Templeton, we talk about, and I tell the story about how, saying to my kids, will anybody follow me in my career? And my daughter goes, no, Mom, I want to do something that helps people. And I was like, are you kidding me? And I get excited about what we do because it is so important in helping people. And, I think you can feel whether that's a genuine passion about whether people feel that or not in our industry.
How do you hire?
Look, I think I'm with Jenny. I mean, there are lots of tools now that help us, but at the end of the day, we are in a business of delivering for people. And so that desire to be curious, to learn, to be entrepreneurial, a lot of the skills that are being taught these days in college, I think in 3-5 years' time, it's going to be something else. And so it's that core desire to stay current, to understand, to learn from others, to bring others along with you as you seek solutions. I think those are some of the qualities that I think are very persistent over time.
Can you tell in the first meeting whether it's going to work out if you meet someone that you want to hire?
I think there is a desire to come to a conclusion very quickly, but I do think it takes some time to really watch and observe and try to understand, the motivations around decisions that they've made in the past. What are those key sort of value trade-offs that they've made? I think some of that essence, I think, is quite important.
I'd say if we haven't all admitted that we've hired the wrong person for a certain job, we're lying to ourselves. It's hard. You try to do it. I think that one of the key things is you also have to then make a decision to make a change if it doesn't fit.